please subscribe and don't forget to press the bell icon to get notified whenever we upload a new video.
Let's move to, well, money markets and their impact on stocks actually. The 10-year bond yield has now spiked to 7.3% this morning, at the moment standing at 7.299. Well, there would be an impact obviously on the borrowing cost for NBFCs. We are inviting a veteran from that space. Sanjaya Gupta, the Managing Director of PNB Housing Finance, has joined us now. Good morning, Mr. Gupta. Thanks much. Well, does your cost of finance go up because of this rise in bond yields? Will you be able to pass it on to your borrowers?
Well, one is that Lata, the cost of borrowing is seeing a headwind right away. So it will take some time to really, make a difference in our total basket of borrowings.
Of course.
But not immediately, but if it continues, yes, then it will be. And when it comes to passing it on to our customers, then about 82% of the portfolio is on variable interest rates. So we can pass it on. But the beauty is that, the exact borrowing cost enhancement in a basket will have not that much impact on our individual customers.
Okay. Could you drill it down to some detail, Mr. Gupta? On an average, how much do you expect will the borrowing cost will rise for the second half of this year vis-a-vis the first half?
Well, I'm expecting on the total borrowings, it will have an impact between 12 to 15 bips.
Okay.
And because all borrowings are not bond-based borrowings, there are different lines of credit,
Sure.
Including FCTLs, ECBs, NCDs, our retail deposits, etc., CPs and all.
Okay.
So 100% of the borrowing is not going to see that sort of a headwind.
Fair.
Okay. Mr. Gupta, good morning. Since we are heading into a new year, can you tell us a little bit about how the business is looking? Because, give and take everything, the home loan to GDP ratio of India is much less than other countries like China, etc. India stands at just 9%. So the market is relatively underpenetrated. I want to understand from you, in Tier 2 and Tier 3 cities, what kind of loan growth do you hope to see over the next 1 to 2 years?
Well, these are the engines of growth, and we are seeing Tier 2, Tier 3 cities really looking up, and people are investing in their new homes. And these are basically home buyers who are actual home users. So we are expecting that that will sustain for some years to come. And we are also building our capacities to match that demand.
Okay.
And things are looking all right. Things are not too bad.
Okay, Mr. Gupta, you're growing your AUM at a frenetic pace. Now, just a bit of worries that this kind of growth normally sparks. 30% of your book, we understand, is non-home loan book or non-individual home loans. Of that, 56% is loan against property. Is that, an area that one should worry about in terms of, say, NPAs or possible defaults?
Okay, let me first put, a little bit of facts correctly. 80% of our portfolio is retail portfolio, out of which 60% is pure home loans. Another 16% is LAP, or loan against property.
Okay.
And the remainder, 20%, about 12% is construction finance only for residential units. And the remaining 8% is equally divided between lease rental discounting, LRDs,
Yes.
and corporate term loans. And we are not seeing stress in any of the pockets particularly.
Okay.
So, our portfolio is performing pretty all right.
Even the construction finance?
Even, construction finance, in fact, is behaving pretty good. In fact, don't like to go on records, but the fact is that the choice of the developers and the choice of the projects are making a lot of difference. We are seeing sales velocities, we are seeing good collection efficiencies, and there's nothing to worry on the construction finance.
Just one number, you think that you will be able to maintain this pace of growth of your AUM?
Well, I really wish we can, and the markets are looking fine. The industry or the sector is responding very well to our capacity building. This particular year, 17-18, we are doubling our capacities. So I think it will stand us in good stead for the years to come by.
Okay. All right, we'll leave it at that, sir. Thank you very much for joining us.